Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Jake Remley, Senior Portfolio Manager at Income Research and Management, to discuss why embedded inflation pressures could keep interest rates elevated for a prolonged period of time and how to be positioned in fixed income. Jake, it's great to have you with us. Welcome to Trade Talks.
Yeah, my pleasure, Jill. Thanks for having me.
All right. When we think about your longer term outlook, is economic uncertainty here to stay?
We think so. So I think in the bond market, when you talk about here to stay, it's the next 12 to 18 months that we're looking at. And with core CPI below 5%, the Fed is making progress against inflation, but there's still job openings and wage pressures that are just too hot for the inflation to really sustainably get down to their target, which is 2% at this point in our eyes.
So how are you positioned across fixed income?
Yeah, so we do like the fundamentals of corporate bonds and securitized bonds. We think that the additional spread that you get by being invested in those areas can get you up over 6% in many parts of the curve. And we haven't seen that type of all-in yield in high quality bonds for the better part of 15 years. So we do think that's attractive, even if interest rates do continue to creep up here.
And you're active value bond investors. Where do you see value in the fixed income space? And where is the risk return when you think about the front end versus the longer end of the curve?
Yeah, I think for investors that are leery of interest rate risk, the front end is the best spot to be at this point. You know, it really is going to get you a very attractive yields. You know, with the curve still inverted, you're going to get maybe 6.5% with corporate bonds and the like on the front end, and that can get you a nice diversification piece in your broad asset mix to help you, I think, especially with liquidity and in more difficult times like we had in March.
Where are you underweight?
Longer treasuries and longer corporate bonds, we're not as excited about. Longer treasuries, really, because the curve's inverted. You know, you're actually giving yield to lock your money in longer, which from our perspective isn't ideal, given that you could have better reinvestment opportunities here in the near term if rates do continue to go up. And then corporates on the long end, while we like the fundamentals, they've just been tighter and tighter on spread as we go here. I think a lot of it's from the passive indexing and also the liability-driven investing that is taking place on the long end of the curve.
And of course, Jackson Hole was last week, and Powell's speech to me sounded like this could be higher for longer. Do you anticipate any cuts in 2023? And if not, what do you think the time frame might look like for 2024?
We don't see any cuts this year. It's just too cuspy in terms of the inflation picture from the Fed's perspective. You know, it's nice that it's coming down, but if you get any kind of pressures in food and energy this winter, you could see it shoot right back up again. And that piece of it, I think, is going to keep them sort of in their third phase of what they've been talking about with rates higher for longer as they continue to fight this inflation battle.
Yeah, it seems as if it's going to be a challenge to get down to the 2% core, which is their target. There's been some speculation they might even raise that target, but that just doesn't sound feasible either.
Yeah, they've given us no indication they're interested in raising that target. And so, you know, from our perspective, you know, get the last mile, so to speak, from where they are now or even a little bit lower to get to that 2% is going to be the hardest and longest of this whole disinflationary fight that they're involved in.
Right. So it sounds like the long and the short of it is that you're going to have to remain nimble in the fixed income space, at least for the next 12 to 18 months.
Exactly. Nimble and liquid.
All right, Jake, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.